Hey there, we've got an exciting lineup for you today. After peering into the 13F filings of legends like Michael Burry and Warren Buffett, we're back with a fresh batch of stocks that other big-name investors have been snapping up during Q1 of 2023. Get ready, we analyzed the latest 13F filings from investing gurus like Mohnish Pabrai, Bill Ackman, Ray Dalio, and Seth Klarman. We've crunched the numbers and curated a list of stocks that are mostly bought by those investment giants. So fasten your seatbelts, grab some popcorn, and let's unveil the screen together. It's time to discover which stocks have caught the attention of brilliant super investors in the thrilling Q1 of 2023. Are you ready? Hit subscribe below and let's get started. The first favoritized stock by super investors in Q1 is Meta. This stock has had its fair share of challenges, like a wild roller coaster ride through the metaverse. With their lavish spending on metaverse development and a decline in advertising profits, Meta has been feeling the heat. They face hurdles like Apple's ad targeting changes, macroeconomic woes, and the struggle to monetize short-form videos. Whew, that's quite a trifecta of headwinds. The stock took a nosedive, plummeting around 70% from its 2021 high to its 2022 low. Ouch! But wait, buckle up for the twist in 2023. Since hitting rock bottom in November 2022, Meta shares have skyrocketed by a mind-boggling 200%. Talk about a rebound. It's no wonder our super investors have their eyes on this stock, enjoying the bounce and believing there's more room for upsides. Meta is on a mission to boost efficiency this year, declaring it a critical task. And guess what? The recent earnings report has shown some positive vibes. Sales are on the rise year over year for 4 consecutive quarters, with a modest 3% revenue increase. Although their operating margins took a slight hit, dropping from 31% to 25%, but there's a ray of hope. Meta's optimistic guidance for the second quarter predicts revenue between $29.5 billion and $32 billion, a sign that the company is resilient and a comeback may be around the corner. As renowned investor Peter Lynch once said, you don't always have to be in a stock when it goes from good to great. Sometimes finding those turnarounds from crappy to semi-crappy can be just as lucrative, especially when institutional money starts swinging the stock back in the right direction. So it's an intriguing time for Meta, but it's no surprise that it finds its place among the most purchased stocks by our super investors. Clearly, the smart money is confident in the long-term prospects of this business. The next stocks favored by our super investors in Q1 may be a little surprise to you. It's Intuit. This finance management software provider for small and medium-sized businesses caught the attention of 7 of our super investors during the quarter. You may recognize Intuit from their well-known brands like TurboMax, Credit Karma, QuickBooks, and MailChimp. Now let's break it down. Intuit operates across 4 key revenue segments, but its success heavily relies on 2 of them, QuickBooks and MailChimp, serving small businesses and self-employed individuals, and TurboMax, catering to consumers. These segments make up a significant 80% of their revenue and contribute substantially to their segment operating income. While the super investors find promise in this space at a glance, it doesn't appear to be a bargain. Since the completion of the MailChimp acquisition in late 2021, the stock has dipped, but it still hovers around $445 per share, resulting in a price-to-earnings ratio of approximately 55. With rising interest rates pose a risk to their Credit Karma business, and any increase in unemployment could negatively impact TurboMax, there are certainly challenges that Intuit needs to overcome. And that is it for Intuit, and we're going to move on to the next stock, the tech giant Microsoft. Microsoft is making waves in the world of super investors. During Q1, many of our investing legends couldn't resist taking a bite of the Microsoft pie, especially with the AI frenzy that's been going on. Ever since the debut of ChatGPT in November 2022, Microsoft stock has been on a rocket ride, soaring by a whopping 50%. Now, Microsoft doesn't actually own OpenAI. However, it does hold a significant stake in the company. Back in 2019, Microsoft sealed a massive $1 billion deal, becoming OpenAI's exclusive tech partner. And just earlier this year, they doubled down on their partnership with an additional $10 billion investment. While the financial impact of ChatGPT on Microsoft might not be monumental just yet, the market is already buzzing with excitement, factoring in the future of AI when it comes to Microsoft's stock price. Bill Gates himself has joined the party. Microsoft is now the largest position in his foundation's portfolio. And here's a juicy tidbit for you. During a recent dinner conversation, Mohnish Pabrai had the opportunity to chat with Bill Gates, who firmly believes that Microsoft has an unbeatable lead in the AI arena. Now that's an endorsement. Anecdote aside, let's not forget the heart of Microsoft's success lies in its core business. They've built an empire with a plethora of software offerings, from the iconic Windows to the mighty Office 365, the powerful Azure to the addictive Xbox Game Pass, the professional LinkedIn to the dependable OneDrive, and the collaboration powerhouse Microsoft Teams. They've crafted an ecosystem that keeps customers locked in and revenue pouring in quarter after quarter. While AI might be stealing the spotlight, it's the unwavering strength of Microsoft's core business that entice our super investors to join the Microsoft party. So, keep your eyes on this tech giant as they continue to dominate both the present and the future. Now let's shift our attention to the next most bought stock on our list, Amazon. From November 2021 to December 2022, Amazon experienced a steady decline that effectively brought its stock back to 2020 levels. What caused this downward trend? In recent years, Amazon has been unwavering in its efforts to expand capacity and drive revenue and profitability. However, the persistent inflationary pressures have presented a hurdle, with costs rising at a similar pace. Expenses related to goods sold and operational expenditures have climbed, ultimately impacting the company's earnings. It's undoubtedly a period of short-term adversity for Amazon. Nonetheless, many value investors are optimistic that this phase of intensive investment will lay the foundation for long-term prosperity, and history has demonstrated that Amazon is well versed in its strategic approach. When it comes to allocating capital, Amazon consistently takes the spotlight. While other companies like Alibaba, Google, Meta, and Apple hoard their cash reserves, Amazon takes a different route by reinvesting its funds into growth opportunities within its own business. This forward-thinking approach is precisely why super investors are doubling down on Amazon. They possess the ability to see the bigger picture and recognize Amazon's unwavering commitment to continuous expansion. Amazon is a hungry company, always seeking out new opportunities and avenues for growth. And now we arrive at our final contender for the most sought-after stock in Q1 of 2023, Google. It comes as no surprise that Google consistently secures its place among the top ranks. Despite challenges around ChatGPT, Google has displayed remarkable resilience in maintaining its revenue. With the added momentum of its cloud business and a rock-solid balance sheet, Google is a veritable money-making machine. Even during times of economic downturn, this company steadfastly moves forward without missing a beat. One of Google's greatest strengths lies in its internet search. Unlike other companies, no device manufacturer can truly challenge its dominance. In fact, devices themselves rely on Google, placing the company in an exceptionally advantageous competitive position. Everyone utilizes Google, and there isn't even a close competitor in sight. This kind of unrivaled market dominance safeguards their cash flows, even amidst a challenging macroeconomic environment. Let's delve into some impressive figures. Over the past 4 quarters, Google has consistently demonstrated an improvement in its free cash flow, defying the odds of a turbulent economy. And if that weren't impressive enough, consider this. They boast an astonishing $115 billion in cash and short-term marketable securities, while their total liabilities amount to a mere $108 billion. When you combine all these compelling factors, their formidable moat, sustained profitability, robust balance sheet, and the fact that the stock was trading around $90 per share in Q1, you have a winning formula that enticed a multitude of super investors to eagerly hop on board the Google train. So there you have it, folks. These are the top 5 buys from super investors in Q1 of 2023. And if there's one thing we can take away from this list, it's that these savvy investors have their sights set on companies that have proven their resilience and potential for long-term success. Do you think these stocks have much potential from here? What other stocks do you think should make the cut? Comment your thoughts below. And if you like this kind of topics to be delivered to you on a regular basis, hit that subscribe button and give it a thumbs up. We'll see you in the next video.